he talks about conglomerates and why they're not very good in this letter. Berkshire Hathaway is a conglomerate. They operate a little bit differently. They'll buy companies in pieces, not in their entirety, and that allows them to be much more flexible and have a bigger pool of companies that they're looking at. But if they're not getting the same valuation for Clayton that they would get on the open markets, is it worth having all these companies in the conglomerate?
Well, there's basically the nature of what he looks at is cash flow, quality of the cash flow, and evaluation on that multiple of cash flow. So in terms of my reading of it, not his, he doesn't talk about the conglomerates except for the pointing out that investment bankers love it, pushing an illusion. The illusions last for a long time. He goes back to the 60s when I was there watching Charlie Blue Dawn, Jimmy Ling, Janine, and so on. The conglomerates were looking at things to try to put together a cycle position for Wall Street. But he uses that analogy, Becky, also to talk about today as to how companies are put together for Wall Street, not necessarily for operating cash flow. There's a lot of detail. For example, in Clayton, he talks about how well they did in the annual. But if you go into the details, they only sold 2.5% more manufactured housing. And when you blend them together under his orchestra leader, how does he look at that? So I would think in quotes, the conglomerate discount has value. A lot of companies that I follow sell at a discount from what I think the takeover price would be. So if you want to take over Berkshire, you're going to pay a much higher price. You're not going to do it because it's unlikely. And then what is the benefit of splitting it up? When you split it up, you got $280 million, of which $130 million relates to the float that he's got in the insurance company. So there's a lot of moving parts. I just don't see him coming to that conclusion. And I think
No, I don't either. I don't either. The Class A shares prevent it with the voting structure anyway, but I'm just asking if you kind of see that.
No, I don't see it at all. I think that, stay the course. It works. When I started buying the stock in 1986, I only bought it for my two mutual funds, Becky. I still own it, like 240 shares. It was the Asset Fund and the Equity Trust, two of the first that I started in what I do as a methodology. And we got a $6,000 cost. Why do I want to split it up if I'm going to monetize it? I'm glad he doesn't pay a dividend. However, observers of our mutual fund would say because we hold things that long, they say we're not an active manager because we don't have high turnover. You can't you can't please everyone all the time.
Yeah, I think that was his point in the letter too. You want the investors you want.
He does. He talks about his investors in those buckets. He puts them in 5 categories. That's the first time he's done that. And he doesn't talk about cash dividends. He's not going to do it. But the other thing he doesn't talk about is taxes. Normally, he would talk about how taxes would work and the environment that we're going into on a corporate basis. What happens if the book tax for unrealized gains goes up? How much is that going to impact them? For example, he increased the value of the book value of his company when they lowered corporate tax rates. So those are a lot of details. And you don't want to overanalyze one company. But so step back. $120 billion in one stock, 1/4 of the company is in Apple. So when they say he's kind of looking at things like that, he's got a barbell. Operating companies that are going to do quite well in the next 2 years, extraordinarily well, except for a question mark over insurance. There's an accounting rule. I don't want to get into that, but critical audit matters, CAM, is the new rules that auditors have to identify companies as to what's important. They look down and drill into the question of the liabilities in the insurance companies. How does England dealing with the COVID-19 and the insurance companies? How are we doing it in the U.S.? What's going to change? So there's a lot going on. It's a fun annual report to read.
Yep. And it's fun having you on to talk.
Shepard Smith here. Thanks for watching CNBC on YouTube.